Well, I think that short term, you could see liquidations that are survival driven. In other words, survival driven selling that can trigger volatility and sell offs. These are because the big shorts right now. There's something called a lease rate in London, and that lease rate is normally like 1/2 to 1%, meaning I'm going to naked short something and I need to lease metal to pay it back, or lease metal to naked short it to begin with. That lease rate is normally 1 or 2%. It's now 100% annualized. There is no metal to be leased. The liquidity has been sucked out of the system. The banks don't want to lease the metal. You're going to get people that are screwed and are going to have to margin call. Medium term, once that forced selling ends, which I suspect should be very soon, that's when the fiscal scarcity dominates the marketplace. This is when you see a sustained price well above 50. But long term, this is all about the paper price, the confidence in the paper price collapsing. This is when you see a structural reset in the price of silver as it moves towards 75 or 100. With new settlement hubs, as I might mention, as we've talked about in Shanghai, in Dubai, in India, in the Belt Road Initiative, and all of these exchanges that the Shanghai Metals Exchange is building. So we are entering a new reality as far as I'm concerned in gold and in silver. Look, let's not forget about gold. It's on pace for its strongest year ever. It's up 60%. Silver, on the other hand, is approaching 80% for the year.
Something massive is brewing behind the scenes of the silver market, and it's moving faster than anyone imagined. According to Andy Schectman, bullion banks are now engaging in survival-driven selling. This isn't ordinary trading, it's panic liquidation. These banks are dumping paper silver just to survive margin calls and liquidity shortages. In London, the silver lease rate, usually around 1 to 2%, has skyrocketed to over 100% annualized. That means one thing: there's no silver left to lease. The liquidity has been sucked dry, and big players are scrambling to find physical metal, not paper promises. We've entered a new financial reality, a market where physical scarcity trumps paper speculation. Andy Schectman warns that once this wave of forced selling ends, the real shortage will drive a historic breakout, pushing silver well past $50 and potentially into the $75 to $100 range. This is the beginning of what he calls a structural reset for silver, led by new settlement hubs rising in Shanghai, Dubai, and India, the very heart of the global Belt and Road network.
Yeah,
gold is up for 9 straight weeks, brother. 9 straight weeks, and here we are at $4,200.
I mean, with everything we're seeing right now, India funds halt silver ETF investment amid unprecedented global shortage. In other words, the ETFs can't come up with the silver. It doesn't exist, so they're no longer canceling, will not let them purchase any more paper silver.
Yeah, that's that kind of stuff's happening all over the place. We've been seeing dealers around the country run out of product, or at least the ability to sell anything, until they get a better grasp on what's going on. There's rumors that the Perth Mint has shut down taking new orders right now. This is what,
did you discuss with Mark about all the backwardation? I think that's a big part of it.
Yeah. Do you know what backwardation is, Mark?
No, enlighten me.
Okay, well that's really the big deal, is that backwardation is something that is very, very, very rare in silver, and it's very rare in anything for that matter. Normal markets work on what's called contango, and then contango is where the futures price is ahead of, in terms of price, and ahead of the spot price. Think of it, me loaning you some money. If I loan you money and you say, Andy, can I borrow $500? I'm going to pay you back tomorrow morning. Sure, Mark. there's not going to be any interest that I'm going to charge you. If you say, Andy, can I borrow $500 and I'll pay you back in 18 months? I might say, okay, but for the loss of the use of that money, I'm going to charge you at 5% interest annually. So you're going to end up paying me back $575 in 18 months. That's contango. Backwardation says, I'll tell you what, I know that if I were to pay you in 18 months, it would be $575, but I'm going to pay you $595 today because I just want it right now. In other words, when you talk about backwardation, it's where the futures price is less than the current spot price. It's very, very, very rare. We've seen it as high as $2.50 to $3 an ounce over the last few weeks. What it means is there's tremendous strain and stress in the physical market, that the players who need their metal, they want it right now. They don't want the paper promises. They do not want to roll forward their contracts.
And they're paying up for it.
And I'll give you an example of how that affects this industry and why it affects people where companies aren't able to deliver right now. So let's say one of your listeners called me and said, Andy, I need to sell 10,000 silver maple leafs. Sure, I'd say, Johnny, I'm going to buy those 10,000 silver maple leafs from you. Here's spot price. Spot price is $52 an ounce. But the futures price right now is just under 51. So in order for me to hedge my exposure, which I always do to inventory, where I will take the opposite side of the transaction to protect myself. In other words, if I have 10,000 ounces in the warehouse and I have 10,000 ounces on paper that I sold short, if my warehouse drops by $10, I'm out $100,000. But what I sold short goes up by the same amount, so I'm market neutral. But if the futures price is 5, 8, 10% back of the real price, how do I hedge my exposure with futures contracts that are not matching up with the spot price? It's creating a lot of strain and a lot of stress in the marketplace. And the implication really is that the delivery of physical metal is far, far more relevant to the big players right now than it is accepting the promises of the exchange in a paper form. That makes sense?
I think it makes sense. See if I'm following. In a nutshell, they're willing to overpay so that their shorts, they don't get caught with their shorts down later.
More or less, yes. I mean, buyers are desperate for immediate delivery is what it really means.
Oh, prices didn't go down until somebody craps a crap ton of physical metal and dumps it on the market. Until then, price isn't going anywhere.
Right. But then you add on to it the physical delivery stress of almost 17 million ounces already been delivered in the month of October alone. Just in a half a month, we've seen 17 million ounces delivered on COMEX, and London spot silver has been as much as a $3 premium to New York futures. This hasn't been seen, if ever, maybe once for a moment in 1980.
I don't think, but to the extent where there was such a big, basically between the bid and the ask.
What happened in 1980? I mean, what happened to price or volatility or
the Hunt brothers?
But 1980 was a little different.
When silver took a run.
Right, but if you also remember, it also took a big fall. The hold at the $50 level was very, very short-lived. You know, the question most people are asking now is spot going? Is the futures market going to get up to the spot price, or will the spot price retreat back to the futures price? I would tell you, certainly based on what we're seeing here, I would imagine that the futures price has to come up to the spot price. Should we be buying more? Suzanne Powers, should we be buying more silver or gold? I think still right now with the silver gold ratio, I think silver is the better bet. I think we buy silver with, of course, the long-term philosophy that when the ratio normalizes to around what we believe should be the start, call it around 45 on the GSR, then we start peeling off the layers of the onion and swapping it for gold. I think silver is definitely the better bet. The question is, and the difficult time now, is actually getting your hands on silver. So
yeah, and a lot of people are like, it's so high right now, maybe I shouldn't buy it. A lot of people are that mindset. The problem is, what happens if it never comes down here again?
Yeah, well,
there's a high probability of that as far as
There's
I'm
an
concerned.
excellently high. There's far more chance of that, or a devaluation of the U.S. dollar, which means it's going to take even more to buy it. In other words, it's a bargain right now, potentially. I don't know.
I think that, Mark, if you listen to any of the major guys out there or girls out there, I think that
good for you being politically correct.
I'm always politically correct, not always, but I think that we will probably be seeing in the next, I don't know, a couple of weeks, we'll probably see it. But I think that we've built new support levels. 30 was the last one that we saw. We ripped through 40. And I think that 50 will become our new support level. And I truly think that the next level that we'll be seeing some maybe hesitation, real resistance is probably 80. But as Andy would tell you, just based on that cup and handle formation, 96 is probably the number that I'm going to be looking at. 90.
To understand what's happening, let's look at the bigger picture. Gold is having one of its strongest years ever, up around 60%. Silver has surged nearly 80%, climbing for 9 straight weeks, even as India's UTI Asset Management just suspended new silver ETF investments because they simply can't find enough metal. Reuters, October 2025. At the same time, dealers worldwide are running out of supply, and reports suggest that even the Perth Mint has temporarily stopped taking new orders. This all ties back to a rare market condition called backwardation, where the spot price is higher than the futures price. Normally, in contango, futures cost more because of time value. But right now, spot silver sits around $52 to $53 an ounce, while futures hover near $51. Buyers are paying premiums of $1 to $3 per ounce just to get immediate delivery. That's a flashing red warning. The physical market is broken, and the paper system is losing credibility. On the COMEX alone, over 17 million ounces have already been delivered in just the first half of October, while London spot trades at up to a $3 premium over New York, something not seen since the 1980 Hunt Brothers silver run. Schectman believes silver has built new support at $50, with resistance likely forming around $80 to $96, a projection supported by the long-term cup and handle technical pattern. He also reminds investors that the gold-to-silver ratio still favors silver as the better bet for growth. When that ratio normalizes around 45 to 1, seasoned investors can start swapping silver profits into gold. Meanwhile, in Washington and Wall Street, a larger transformation is taking shape. Economist Stephen Mirren's proposed Mirrago Accord could peg long-term U.S. Treasuries to gold, a move designed to restore zero-cost borrowing and bring manufacturing back to America. At the same time, former Trump crypto advisor Bo Hines now leads USA Tether, which may soon back every digital dollar transaction with treasuries, gold, and Bitcoin. This means the next wave of currency could be both digital and asset-backed, effectively devaluing the dollar while driving gold and silver even higher. Schectman calls it the Great Debasement Trade, a deliberate policy shift where the U.S. weakens its currency to rebuild industry and export power. But for investors, it's a clear warning. Saving in cash could become the fastest way to go broke.
I still remember, upper 20s and me having the, should I even be buying anymore? And I did.
Yeah.
But
can they see that, or is that backwards?
Do you see that, Mark?
Oh, yeah.
What are we looking at?
Those are some good numbers, huh?
So gold is sitting right now on the futures market. Gold sitting at 42.10. Here's a perfect example of what the backwardation is, Mark. Silver futures are at 51.43, but the spot market on silver right now is just a hair under 52.90. So
yeah,
we're
52.83 on the Miles Franklin site.
Yeah, so we're still, about a good $1.50 away in between that bid ask and that spread between the futures and the spot market. So it's narrowing a little bit because 2 days ago we were at about 2.5. Now we're at 1.5, but we're not close to where we should be. Usually it's about maybe a 20, 30, 40 cent differential between the futures and the spot.
Someone said they heard me predict 96. I do. That would be the tactical spot. You know, we're just beginning. We truly are just beginning. I believe that in my soul. We are watching the great debasement trade. The dollar is being debased right out from underneath us. And I've said this on your show before, and I will stick to it. Gold and silver will go higher than any of you think possible. That is not why you buy it. You buy it because the dollar is dying right out from underneath us. It is the only way that you can bring back manufacturing is to give up on the reserve status and sell your manufacturing into the massively devalued dollar. That is the premise of the Mirrago Accord. Stephen Mirren, he says, say nice things. Of course we say nice things about you, Mike.
Orchie's the best.
So the Mirrago Accord and Stephen Mirren, who is the architect of that, has filled the vacated spot there. And Judy Shelton was on my show again. This time Michelle McCory interviewed her, and she said again, it's gaining traction. They're going to peg the back end of the Treasury market to gold. They do that. They will do that so that on the 5, 10, 20, 30, and ultimately 50-year Treasury redeemable in gold, they can bring back manufacturing at zero upfront borrowing costs. Now, the interesting thing is, you know, you want to talk about putting the dots together. You know who Bo Hines is?
Yep.
He is was the crypto czar for Trump until August. Now he's the president of USA Tether. Every single dollar transaction that we all make in the next several months and indefinitely forward will be backed by USA Tether. That metal, that money will all go into U.S. Treasuries. The difference in the interest from the Treasuries to what we get, we don't get any money on those. We don't make any yield on those stable coins. It'll look like dollar bills to us on our bank accounts, but it transacts through stable coins like that, like Venmo or Zelle, instead of the time it takes to clear a check or a wire. But the interest that USA Tether gets on the Treasuries, backing all of the stable coins, every dollar you spend will travel this way. They will buy more Treasuries to push down interest rates, and they'll buy gold and Bitcoin. And the act of buying more gold, they already have $8 billion in gold in Switzerland in a vault. They were just at the Beaver Creek Mining Summit, buying directly from the miners. The act of buying more gold devalues the dollar further. The act of buying more Bitcoin devalues the dollar further. The act of backing it with Treasuries decreases interest rates. They are going to try and make the dollar worth toilet paper in order to sell our manufacturing to the rest of the world and grow our way out of this problem. And you do that by revaluing gold, let it get to $6,000, $7,000, $8,000, and then revalue it much higher. But until that happens, saving in dollars is the fastest way to go broke. And as far as silver and platinum, the U.S. government has classified them critical minerals. There's not anything more you need to know. Oh, look, investing.com, gold has topped $4,200.
So one of your listeners, Coyote Boy Mark, asks, Andy and Kevin, would you recommend selling gold and buying silver with the proceeds? I mean, I think that it's a great idea, but just keep in mind that when you do sell gold, it will trigger a taxable event.
Unless it's in an IRA.
Correct.
So, what should you do right now? Andy Schectman's advice is crystal clear. Buy physical precious metals, especially silver, and hold them outside the system. He says silver and platinum are now officially classified as critical minerals by the U.S. government, a strong signal that these assets are strategically vital and in short supply. Yes, prices have already soared. But ask yourself, what if they never come back down again? Would you rather wait and miss the run, or secure real metal while you still can? With gold above $4,200 and silver hovering near record highs, central banks are buying at a historic pace, and ETFs are literally running out of metal. FT, October 2025. MarketWatch, October 2025. This isn't a bubble. It's a reset of trust in the entire monetary system. Andy Schectman's core message to investors: gold and silver will go higher than anyone thinks possible, not because you want to get rich, but because the dollar is dying beneath our feet. So here's my question to you. Do you think silver stops at $75, or does it rocket past $100 as the paper system collapses? Drop your thoughts in the comments below. Let's talk about where you see the next move going. And if you found this analysis valuable, don't forget to like, subscribe, and turn on notifications so you never miss the next big update from MacroEdge, your source for real insights before the mainstream catches on. Because when the dust settles, it's not the paper traders who win, it's the stackers who saw it coming.